Equity markets saw further gains during the June quarter, with global equities in Australian dollar terms ending up 3.6%. Listed infrastructure securities outperformed during the quarter, with the FTSE Global Core Infrastructure 50/50 Index up 4%. Our funds saw a return of 3.6%, thus slightly underperforming the sector during this period. Taking a longer term view, over the past 12 months, the FTSE Infrastructure Index returned 6.7%, compared to our fund return of 7.3%. For our currency hedge fund, the fund delivered 2.5% after fees for the quarter, compared to 3.6% for the FTSE Australian Dollar Hedged Infrastructure Index. During the quarter, regulated utilities and airport concessions saw strong stock performance, and our positioning in these sectors was a positive contributor to performance. The pipeline sector, however, produced weaker performance, and our positioning detracted. Overall, our stock selection was slightly negative to performance relative to our core infrastructure opportunity set. A factor in our slight underperformance this quarter was weakness in several of our North American energy pipelines, to which we have a larger exposure than the index. As a philosophy, we avoid infrastructure with material direct commodity price exposure, such as the oil price. However, there are some second-round effects on energy infrastructure that we are acutely aware of, including the counterparty risk to producers through long-dated contracts. In our experience, the market does not well differentiate stocks with high commodity price exposure from those with lower exposure, which can provide valuation opportunities. Within the pipeline sector, we're most focused on North American gas pipelines due to the strong long-term demand trends that we see for gas. This demand in the United States is driven, firstly, by the growth in residential gas connections. Secondly, the ongoing switching of electricity generation from coal to gas. And thirdly, the ramp up of LNG exports. And this third factor alone is expected to add more than 20% to the current US gas demand based on the already approved LNG export facilities. Valuations are always the primary focus of our team as listed infrastructure investors, and returns have been good in absolute terms over the last few years. Looking at our current portfolio of listed infrastructure companies, we view the sector as fair value when compared to historical levels of valuation. Within the wider infrastructure market, we can see pockets of both overvalued and undervalued regions, sectors and stocks, so stock picking is therefore very important. Infrastructure earnings multiples are modestly above where they have been over the long term, and we think this is fair given our outlook for interest rates. Our view is that they'll increase, but settle at a lower level than we've experienced historically. The average gross dividend yield of the portfolio holdings is around 3.7%. We expect that to grow at around 6% per annum to at least 2020. It's also worth noting that we see cheaper trading prices in the listed infrastructure market currently compared to where we're seeing comparable transactions in the direct or unlisted infrastructure market. Over the quarter, we continued to shift the portfolio towards stocks that we view as having greater upside potential. Holdings of North American pipelines are increased following their weakness, whilst positions in European airport concessions were reduced following a strong rally. Looking forward, we remain optimistic about the long-term attractiveness of the infrastructure sector as an investment, given the ongoing increase in demand for long-dated, stable income streams by various investor types, and the growing need for further private sector infrastructure investment. We're also confident that our high conviction approach is well suited within this valuation environment, as it requires only a relatively small number of mispriced securities in order for us to build an attractive investment portfolio.